Okay, so in our last class, we talked about all the underlying concepts in capital budgeting. We introduced you to capital budgeting. We talk about the procedures involved in carrying out capital budgeting decision. We talk about the characteristics, methods of project evaluation, where we discussed uh, net present value, internal rate of return, payback period, uh, discounted payback period, as well as accounting rate of return. Of course, we move from there to talk about how to identify relevant cash flows. Okay, then thereafter we talk about the impact of inflation and then taxation. That was where we stopped last time. So tonight we are going to be solving question purely because all the underlying concepts have been discussed. So what we want to do today is to solve questions, and then after tonight, then that will be the end of capital budgeting. Okay, let me see. If I'm able to solve about 3 illustrations, then I'll be fine. So I'll be fine. All right, let me see. Okay, let's start with illustration number 1. Yes, I will read this. Maryland Company Limited is considering the introduction of a new product that has recently been developed at a cost of 2.5 million naira. The project will require the purchase of a new machine costing 14 million naira payable now. So this 2.5 million naira, the 14 million naira, of course, is the initial outlay. The machine can be sold at the end of year 4 for 1 million naira. That's the scrap value. Okay. Market research recently carried out at a cost of 1.5 million naira payable at the end of year 1 indicates a unit selling price of 300 naira in year 1, rising by 10% per annum. Sales volume for the 4-year life of the project has been estimated as follows. Possible unit variable cost as follows. The introduction of the new product is expected to reduce the market demand of an existing product by 5,000 units per annum. The existing product has a unit contribution of 75 naira. Incremental annual fixed costs associated with the new products include the following. It is expected that the introduction of the new product will help to reduce investment in working capital by 750,000 naira immediately. Cost of capital is 12%. You are required to A, advise with relevant calculations whether the project should be accepted. Then B, state and explain briefly 3 factors influencing pricing decisions. Okay, so that's end of the question. Examiner is asking you to advise whether the project should be accepted. Okay, so whenever you are required to advise, evaluate, or determine financial viability of a project, what examiner is expecting you to do is to calculate NPV. So except examiner says otherwise, whenever you are asked to appraise, evaluate, advise, okay, there is no other techniques you are expected to use other than the net present value. So you can only solve for maybe internal rate of return, payback period, or accounting rate of return if examiner is specific that you should use those techniques. Other than that, it has to be NPV. Okay, it has to be NPV. Therefore, you want to calculate NPV based on the scenario. What are you supposed to do? I've told you whenever you have multiple variables, whenever you are given multiple variables, you are expected to use the columnar format to compute your NPV. All right. In this particular question, you have sales value, you have variable cost. Okay. You also have inflation. All right. So it is better for you to use the columnar format. So that will be more presentable. Okay, to make your work more presentable. So if that is the case, let's switch to the working note so that we can solve the question quickly. Okay. So the name of this company is Maryland Company Limited. Solution to illustration number 1. Okay. Maryland Company Limited. Number A, I would then say calculating net present value. Please, don't go and write NPV on the day of your exam. In fact, let me show you what you are supposed to do. Don't write NPV. At the first instance, you need to write it out in full. It should be net present value. Then you can open a bracket, NPV, so that going forward, you'll be referencing NPV. So if you just write NPV at the first instance, so you are given room for examiner to penalize you because examiner may not understand what do you mean by NPV. NPV can be anything, all right? So I would then go back to the question. What's the useful life of the project? The useful life of this project is 4 years. I will go deeper into the question if I'm given tax rates. So in this question, there is no tax. So that means the cash flow will not be impacted with tax. Therefore, I will open, I can say year 0, year 1, year 2, year 3, then year 4. Okay, then the first item will be sales value. My figures are in, let's restrict our numbers to thousands. Our numbers are in thousands, 1,000 naira. Okay, so starting from sales value. Remember, we have a format you are supposed to follow. The first item in your format, whenever you have multiple variable, the first item is your sales value. How do you determine the sales value? So you go to the question, if you are given selling price, okay, before you multiply the selling price on the unit sold, you need to first of all ascertain if you are given inflation rate. If selling price will be impacted with inflation, you need to inflate the selling price before you multiply with number of units sold to get your total sales. Therefore, according to the question, we have inflation. And therefore, so let's go down there and do our working. So this first page will be for the main solution. Then our working can then follow next. Okay. Let's start our working from here. This is a very straightforward question. So the first item will be, let's ascertain the years. So year 1, year 2, year 3, then year 4. Then I will need to indicate the number of units. According to the question, first year unit is 60,000. Here is 60,000, 85,000, 85,000. Then the final year is 80,000. Okay. Then working number 1. We want to determine sales value. So selling price. I will then go to the question, how much is the selling price? We are told that market research recently carried out at a cost of 1.5 million naira payable at the end of year 1 indicates a selling price of 300 naira in year 1. Selling price is 300 naira, rising by 10% per annum. So examiner has told us that the selling price of 300 naira is in year 1 prices. Remember, when I was explaining the concept of inflation, I mentioned to you that when cash flow are stated in year one prices or first year prices, inflation should start from year two. That is, the first year price given to you is the base year price. So you don't inflate the base year price. So you should start inflating from year two. All right. So in this case, I would then say in year one, this is 300. Who is the person making noise then? Azuko, mute yourself. Debbie, please mute. So in this case, let me stop sharing this. Somebody has done place some mark on the screen. So let me stop sharing this and share it again. Okay. Sorry about that. Let's move on. All right. So the inflation rate on selling price, there are two ways I can inflate my selling price. Okay, there are two ways I can inflate my selling price. I will teach you what the method you are supposed to use on the day of your exam. And that is what I expected you to use. Okay, so selling price, the inflation rate on selling price is 10%. All right, so I would then say, I want to inflate the 300 Naira selling price. So you say, remember, when you want to convert this 300 Naira selling price is a real cash flow. So you want to convert it to money cash flow. Therefore, money cash flow is equal to real cash flow multiplied by 1 plus inflation rate raised to power n. So in this case, all you need to do, just say 300 multiplied by 1.1. So it will give you the inflation equivalent. Therefore, I will just say 1.1 because my inflation rate is 10%. All right. Inflation rate is 10%. So I will say 1.1 multiplied by 300 equal to 330 for year two. Again, 330, whatever you have in your calculator multiplied by 1.1, that's 363. Multiplied by 1.1, that's 399. Okay. Year four is 399. So with this, I've inflated my selling price. So all I need to do is to calculate my sales. Our figures are in thousands. So the units is A. This is A, is B. Then sales value will then be A times B. So what do you then have? 60,000 multiplied by 300.
18,000.
18,000. Thank you. Okay. Then year two. 85 multiplied by 330. 85
28,050.
28,050. Year three.
30,855.
3855. Year four. 80 multiplied by 399.
31,920.
31,920. Okay. So with this, I've inflated my sales value. So I've calculated the sales value. You don't need to wait until you complete all your workings before you post. So with this, let's go and post 18,000 for first year. Year 2 is 28,050. Year 3 is 3855. Then 31,920 for year 4. Okay, so that's that. Then I will then go back to the question if I have variable costs. Yes, examiner has given us variable costs. So you are told that possible unit variable cost are as follows. So according to the question, Sylvia, please mute. According to the question, you can see that the variable cost given to you also have associated probability. So what that means is that you need to calculate expected variable cost. Whenever you are given a cash flow with probability attached, that means you are expected to calculate expected value. So with this, I then need to go and calculate my variable cost. Okay, so let's go and do working for variable cost. So like I was trying to say the other time, this is what I expected you to use. This is how I expected you to calculate it to impact your, to determine the impact of inflation on the day of your exam. However, if you want to use primary school method, so all you need to do, I can say, for example, let me say, I can say selling price, 300, okay? 300, then 300. Inflation at 10%. Inflation at 10%. Therefore, here will be 1.1 raised to power year 0, 1.1 raised to power 1, 1.1 raised to power 2, 1.1 raised to power 3. Okay, so 1.1 raised to power 1, raised to power 0 is equal to 1. Anything raised to power 0 is 1. So multiply by 300 will give us 300. Nothing has changed. Okay. Then 1.1. 1.1 raised to power 1 equal. Sorry. Multiply by 300. That's 330. Okay. Then the third year, 1.1 raised to power 2 equal. Multiply by 300. 365. Sorry, 363. So the last one, which is 1.1 raised to power 3. Multiply by 300. That's 399. So you can see. So, but again,
let her play small, like how you used to do it. Let her play small, they should give you.
if you make noise again, I will remove you from the platform. You are disrupting my class. You know I don't like it. Please mute. Sorry about that. Let's move on. Yes, so either you use this method or you use this method. Whichever one you use, you are good to go. But again, the first one is faster. So I don't need to go and be stressing myself to be doing all of this. It's a waste of time. Then number 2, we want to calculate variable costs. To get the variable costs, examiner has told us that there's probability attached to the variable cost. So if that is the case, I can then say, I need to calculate expected variable cost. So to get the expected variable cost, we create a column for probability, then the cash flow, then we have the expected value, which is the expected variable cost. So probability of the first one, the first probability is 0.4, then second one 0.6, 0.40, 0.60. The cash flow is 240, 260. Here is 240, then 260. Multiply 0.4 multiplied by 240 equal to 96. You know, we have done this under risk and uncertainty, so it's not new to you. 0.6 multiplied by 260, 156. So you add it up. Okay. So what I'm looking for is expected value.
252.
252. So expected variable cost is 252. So at this point, I can then calculate for each year. For year 1, year 2, up to year 4. Okay. Year 1, year 2, year 3, and then year 4. So there is no inflation for variable costs. No inflation for variable costs. So if that is the case, all I need to do is to multiply that with number of units. Okay. So yes, Joy, you raise and talk to me.
I just got confused now. This stuff that you did, the probability, the cash flow, and the is it expected value? How did you do it? Sorry.
How did I do it?
Yes, how did you get it now?
You multiply probability with your cash flow to get the expected value. We did it in risk and uncertainty. Your expected value is calculated as summation of probability of X. Just multiply probability with the cash flow, that's all.
Okay.
All right. So the units, according to the question, the first year unit is 60,000. So if I like, I can use the primary school method in this case, just to make it explicit. So variable cost per unit is 252, 252, 252, and then 252. The number of units, let's say this is C. This is C. Therefore, total variable cost in thousands will then be equal to A times C. You already have A up there, which is units. All right. Therefore, 60,000 multiplied by 252.
15,120.
15,120. 85 multiplied by 252.
21,420.
21,420. 21,420. Then the final one, year 4.
21,60.
21,60. So with this, I need to go and post 15,120 for the first.
21,60. 21,60.
Oh, okay, 21,60. Thank you, 21,60. Okay. So let's go and post 15,120 for the first year. Variable cost. Let me reduce it. Working 2. Working 1. Okay. Here is 15,120. Year 2 is 18 watts. Your 2 is
21
21,420.
420.
21,420. 21,420. Then 20,160.
2160.
Okay, so that's that. I would then go back to the question if I have any other relevant cash flow like incremental, attributable, or specific fixed costs. So, according to the question, you also told that immediately after the variable cost, you are told that the introduction of the new product is expected to reduce the market demand of an existing product by 5,000 units per annum. The existing product has a unit contribution of 75,000. So what examiner is saying is that if this product is introduced, the existing product that the company is selling in the markets will reduce, the sales of that product will reduce by 5,000 units per annum with a contribution of 75 naira. So this is called contribution loss. This is a contribution loss. If not because of the introduction of this new product, the company will not lose that contribution. Therefore, it should be, the cost of the contribution loss should be part of the cost of the project. So let us go and do working for that. Contribution loss. So contribution loss, working number 3. Okay. Contribution loss. So we are told according to the question that 5,000 units will be lost at a contribution of 75 naira. So what do you have there? That should be
375,000.
375,000 naira. Remember, figures are in thousands, so you have to be very careful. So that will be 375 for each year, no inflation. So 375, 375, 375, 375. So we are done with that. Let's go back to the question if we have other information. After the contribution, we also told that incremental annual fixed costs associated with the new product include the following. So examiner has given us incremental annual fixed costs. So under the incremental annual fixed costs, we are given interest on borrowed funds to finance the project, 50,000, depreciation, 250,000, wages, rent, 1 million naira. So how do we treat this information? I want to throw it open. Talk to me. How do we treat the information? You are given incremental annual fixed cost of 1.3 million naira. How do we treat all those information given to us? Kunle, you want to try?
No, sir.
You don't try now. Why do you say no? You have if you meet it on the day of your exam, won't you solve it? Just try your best. How do you trade the information? You know, based on my explanation in our last class in relation to relevant cash flows. So how do you treat all this information you have? The 3 line items: interest, depreciation, wages, rent. How do you treat it? Yep. Joy, you want to try? Talk to me, somebody.
We're
Based on
going
your
to.
okay.
No, ask your question.
I wanted to say, based on our last class, what we did during my explanation of the concepts, how do you treat interest, depreciation, and then wages in this question? Joy, are you still there? Okay, let me go to another person.
Yes,
Amarachi,
I am. Sorry. Sorry.
so how do
So
we treat it?
I think first of all, depreciation is irrelevant. Yeah. So we're
Why?
going to ignore it because it's a non-cash item.
You are correct.
Then
I don't
for
know.
interest, ah, if interest can be, I think, relevant and irrelevant. I don't know if I'm correct, but I don't think it's something we should consider while using
Why?
MPV because it's a cost of capital, something like that, or is already in the cost of capital,
Okay, you have
something like that.
idea. You
Yeah.
have idea. All right.
Then, okay.
Yeah,
Wages
go
and
ahead.
rent. I think wages and rent is relevant.
Mm. Okay, you are not sure. That's why you say you think.
Because it's an indirect cost.
Wages,
Wages. This is indirect now. Is it a direct cost? It's not a direct cost now.
wages,
Wages, rent,
like labor.
like labor.
Right now.
It's direct, oh. It's direct, it's direct.
Okay. You've tried, Joy, to save time. You know, in my last class, I explained that the interest expense is the actual amount paid on the loan borrowed. Okay, is the compensation required by the providers of debt capital. Therefore, I said that whenever you see the absolute amount of interest in a question, please ignore. It is irrelevant because the cost of capital to be used to discount the future cash flows already included interest. So if you now consider the absolute amount of interest in a question, it will amount to double dipping. Therefore, you don't consider interest. You don't consider interest. Whenever you see the naira amount of interest, please ignore. The second one is depreciation, which of course you are correct. Depreciation is a non-cash item. Therefore, it's not a cash flow. It should be ignored. Well, the last one, which is wages, rent, of course, that one is relevant. So we have to account for it. So I would then go up there. I would then say incremental fixed cost. Okay, 1 million. Figures are in thousands. All right. There is no inflation. So just repeat same amount. So we are done with that. Let's go back to the question to identify other cash flows. We are told that it is expected that the introduction of the new product will help to reduce investment in working capital by 750,000 naira immediately. So let's do working for our initial outlay. So we are told that working capital will reduce investment in working capital by 750. Working number 4, the initial outlay. Currently, the initial outlay is 14 million naira. Okay, our figures are in thousand. Initial outlay is currently 14 million. We are now told that reduction in working capital in working capital 750. So the difference, which is 13,250, will represent the initial outlay that we are going to consider. So if that is the case, I will then go back to the question, do we have scrap value? We don't have scrap value. We are not given anything like scrap value. Yes, we have a scrap value in the first paragraph. The machine can be sold at the end of year 4 for 1 million naira. So because in this question, we are not given we don't have a tax, so there's no need for us to just determine profits, so just ignore. So I can then come here to say scrap value. Scrap value is 1 million naira at the final year. So, but if in the question I have company tax rates, immediately after the incremental fixed cost, I have to determine profits. So after the profits, I will charge my tax. I consider tax saved on capital allowance. Then I will introduce scrap value, initial outlay, working capital, if any. But since I don't have tax rate in the question, I'm not going to pay any tax liability. Just move on. Go and get your net cash flow. So in this, the next item will be the initial outlay. Working number 4. We got initial outlay to be 13,250. Initial outlay will occur at the end of year 0. Okay. Now, if you go back to the question, in the first paragraph, we are told that the introduction of the new products, the company is considering the introduction of a new product that has recently been developed at a cost of 2.5 million naira. So development cost of 2.5 million naira, is it relevant or irrelevant? We have a development cost of 2.5 million naira in the first paragraph. Relevant or irrelevant? Talk to me.
Irrelevant.
Why is it not relevant?
It's just like research and development. They are irrelevant cost.
Why?
Because it's been, it's historical cost or sunk cost, as the case may be.
It's a sunk cost. That's the reason why we are ignoring it. It's a sunk cost. Okay? Any cost that have been incurred in the past is a sunk cost. So that's why we ignore the 2.5 million. Then the second paragraph, market research recently carried out at a cost of 1.5 million naira, payable at the end of year 1, indicates a unit selling price. So we have market research that is payable in year 1, okay, of 1,500,000. Relevant or irrelevant? Yes.
It's relevant.
Why is it relevant?
It's a committed cost.
It's a committed cost. Is that the reason why it is relevant?
I think so.
You know, a committed cost is an example of irrelevant cost, meaning that since it's a committed cost, irrespective of the decision taken, it will not change. The company must pay, therefore it is irrelevant if it's a committed cost. But this one is not a committed cost. Yes, any other person? The 1.5 million naira, is it relevant or irrelevant? Yes.
Is irrelevant or
Relevant or irrelevant?
irrelevant?
Irrelevant. Congress, why is it irrelevant?
Because it's some cost as well. Some cost.
It's a sunk cost. It's a sunk cost. You remember when I was explaining cash flow, relevant cash flow, I mentioned to you, I gave you examples of sunk costs. I mentioned market survey costs, okay, market and research and development, feasibility study, all those costs, any costs that have been incurred in the past are irrelevant. Like in this case, this market research, the activity that has been completed, irrespective of when the payment will be paid, it is irrelevant. All right. So we ignore 1.5 million. We also ignore 2.5 million. So what else do we have in the question? I think that's it. That's it. So at this point, let's find the net cash flow. Let's find the net cash flow. You have to state your assumption at all times. So give me the net cash flow for each year. Here is 13,250. Add it up fast. Yes. Let me do for year 330,855. Kunle, are you still there?
For year one,
Yes.
1425.
One what?
1425.
1425. Okay.
Please, you guys should confirm more.
Year 2, 5255.
5255. Okay.
Year 3,
Year
8060.
Okay.
8060. Year 3.
86 8060. Okay.
Year 4, 11,385.
11385. Okay, so these are the net cash flow. At this point, so once you get the net cash flow, you can use other techniques, any techniques to compute your to appraise the project. Okay, except the accounting rate of return. Therefore, since we are calculating using NPV, so I need to discount. The cost of capital given in the question is 12%. So discount factor for year one is what? At 12%. Okay. Discount factor for year one at 12%. 1.12. 1.12 raised to power 1. 1 minus equal. That's 0.893. 0.893. Then year 2. 1.12 raised to power 2 minus equal
797.
0.797. Then year 3, 1.12 raised to power 3 minus. That's
712.
0.712. Then year 4,
0.636.
636. So let's get the present value. Multiply to get the present value. So 11, let me do for year 4, 11,385 multiplied by 0.636 equal 7241. Okay.
Sorry, sir.
Yeah.
Year one is not correct.
So
The
what is year one?
calculation. 1505 instead of 1425.
Oh, okay. 1505. Okay. Yes.
1343.
1343.
Okay. 4.
Pardon?
1344. 1344.
44. Okay.
4188.
4188.
5739.
5739. So
Okay.
So you are going to add up the positive present value, then you net off the negative present value. The difference is the NPV. $7,241 plus 5739 plus 4188 plus 1344 equal minus 13,250 equal 5262. Here is 5262 positive. So since our NPV is positive, then the project is financially viable. So examiner is asking us, okay, examiner is asking us to advise with relevant calculation whether the project should be accepted. I would then say The project is financially viable, considering the positive NPV of 5,262,000 naira. That's it. Okay, therefore the project should be accepted. The project should be accepted. So we are done. We are done with the question. So let me know if you have any question on this so that we can move to another illustration. Any question? If not, let's move to another illustration, please. Okay, so I will stop sharing this. Let's solve the last illustration, sorry, the last question tested on the NPV, tested by ICANN on NPV. So let's have this illustration number 5. Let's have illustration number 5. I need somebody to read for us. Who will help us?
Okay. Illustration 5. Kilimanjaro PLC prepares its accounts to December 31st each year. It is considering investing in a new computer-controlled production facility on million naira. This will enable Kilimanjaro PLC to produce a new product which it expects to be able to sell for 4 years. At the end of this time, it has been agreed to sell the new production facility for 1 million naira each. Sales of the products during the year ended December 31st, 2016, and the next 3 years are expected to be as follows. Year ended December 31st, sales in units, all figures assumed to be correct. Selling price, unit variable cost, and fixed overhead cost, excluding depreciation, are expected to be as follows during the year ended December 31st, 2016. All figures assumed to be correct. The following rates of annual inflation are expected for each of the years during 2017 to 2019. We have selling price 5%, production cost 8%, selling and distribution cost 6%, administration cost 5%. The company pays taxation on its profits at the rate of 30%, with half of this being payable in the year in which the profit is earned, and the remainder being payable in the following year. Investments of this type qualify for tax depreciation at the rate of 25% per annum on a reducing balance basis. The Board of Directors of Kilimanjaro PLC has agreed to use a 12% post-tax discount rate to evaluate this investment. Required: advise Kilimanjaro PLC whether the investment is financially worthwhile. Calculate the internal rate of return of the investment. And C, define the following terms: real rate of returns, money rate of returns. Explain briefly how real rate of return and money rate of return will be applied in calculating the net present value of a project's cash flow. 30 marks.
Thank you, Joy. Yes, that is the question. In the A requirement, you are to calculate, you are to advise whether the investment is financially worthwhile. Again, what we are expected to do here is to calculate the net present value. So without wasting more time on this, let me stop sharing this and move to the working note so that quickly we can deal with the question. Okay. Solution. So illustration. I think that's illustration number 5. Yes, illustration number 5. Kilimanjaro. PLC. So we want to calculate NPV. Requirements number A. So requirement number A, calculating net present value. Figures in thousands. Let's put our figures in thousands or in million, whichever one. Okay. So I will then go back to the question, what's the useful life of the projects? So you are told that year ended 31st December 2016 to 2019. That's 4 years. So let's indicate that. Starting from year 0. Okay. Let's do it this way. Year 0, year 1, year 2, 3, 4. Then I will go back to the question. If I'm given tax rates and when I'm going to pay my tax, according to the question, we are told that the company pays taxation on its profit at the rate of 30%, with half of this being payable in the year in which the profit is earned and the remainder being payable in the following year. So the balance, the 50% balance of the tax of year 4 will be paid in year 5. So let's create additional column for year 5. Okay. So if I like, I can create a column for working. I can create a column for workings. Okay. So I'll then go back to the question. If I have selling price, remember you have a format you are working with. So there's selling price in the question. Therefore, we need to calculate sales value. So let's go and do working for our sales. This first page will be for the NPV. The second page will be for internal rate of return and other things we want to do. Then the third page will be for our workings. So working. So year 1, 2, 3, then 4. All right. Units. According to the question, we are given units in thousands. So units are in thousands. Year 1 is 100. Year 2, 105, 110. 105, then 110. The last one is 108. 108 units produced and sold. Then working number 1, sales. I want to determine sales value. To get the sales value, I need to go back to the question if I have selling price. Yes, we have selling price. I will then say selling price. Let's go and check the nature of the cash flow. You are told in this question that selling price, unit variable cost, and fixed overhead costs, excluding depreciation, are expected to be as follows during the year ended 31st December 2016. Pay attention. Examiner has all the cash flow given to you from selling price to fixed administration cost. They are all in first year prices because 2016 is the first year. So you have been given the first year price. It means that inflation should start from year 2. So if that is the case, selling price is 1,200. Okay. So first year price is 1,200. Inflation rate for selling price is equal to selling price inflation rate is 5%. So we need to convert that at 5%. So this is A. Now bring out your calculator. Let's do it together. Selling price is 5% inflation rate. Therefore, 1.05 multiplied by 1,200 equal to 1260. Here is 1260. 1260 multiplied by 1.05. 1323. 1323. 1323 multiplied by 1.05 equal 1389. So we have inflated the selling price. So say this is B, then sales, total sales, figures in thousands. So A times B, multiply, what do you have? 100 multiplied by 12. That's 120,000. 105 multiplied by 1260 equal 132,300. Next one, 110 multiplied by 1323. 145,530. And the last one, 108 multiplied by 1389. 150,012. Okay, so let's go and post. Sales for the first year, 120,000. I know the last ones, year 4 to be 150,012. That's working number 1. Then year 2, sales value. Be calling the number for me. 132,300.
145,530.
Okay, 132,300. Then 145.
530.
530. Okay.
150,012.
Yeah.
Okay.
So we also have variable costs. So let's go and work it out. Variable costs. According to the question, we are given variable production cost per unit of 750 naira. So let's go and do our working for variable cost. Working number 2, variable cost. Okay, so variable costs at inflation rate of the production cost is 8%. Whether fixed or variable production cost is 8%. So at 8%, the first year price is 750 for variable cost. Here is 750. Therefore, 750, bring out your calculator, 1.08 multiplied by 750 equal 810. 810 multiplied by 1.08. That's 875. Whatever you have in your calculator multiplied by 1.08 equal 745. Is it 745 or 945? 945. Okay, so with this, I've inflated the variable cost. So I need to get the total variable cost. Total variable cost figures in thousands. So this is C, therefore A multiplied by C. So 100 multiplied by 750.
75,000.
75,000. 105.
5,050.
85,050. Next one.
96,250.
96,250.
102,060.
102,060. So let's go and post. 75,000 for the first year. Here is 75,000. It's a variable cost, so cash outflow. 85,050. Then year 3 is what?
96,250.
96,250.
102,060.
102,060. Okay. Let me adjust this one. 150,012. Okay. Then I will go back to the question. All the cash flow we have in the question are relevant after the before the selling price, because you are told in the question that unit selling price, unit variable cost, and fixed overhead cost. All those fixed costs you have in the question are relevant because you are told that fixed overhead cost excluding depreciation. So you remember I told you there are 3 ways examiner can test fixed cost. If you are given fixed cost, no additional information, forget that fixed cost is irrelevant. Provided the fixed cost will not change, it is irrelevant. If you are given a fixed cost, including depreciation, then that fixed cost is also not relevant, but you need to go and calculate annual depreciation, less from the fixed cost, then whatever you have thereafter is relevant. The third way is if you are given fixed cost, excluding depreciation. So any fixed cost that excludes depreciation is relevant. You have to account for it. So the next item will then be that will be variable selling and distribution costs per unit. Okay, so we have variable. Let's go and do working for that. Working number 3. Variable selling and distribution. So inflation rate for selling expenses is 6%. Are you talking to me? Who is that person? Hello? Are you speaking or you are talking to somebody there? Gusha.
Oh, sorry, sir. Sorry, sir.
Okay. So variable selling and distribution expenses is 100 naira. So let's go and inflate that. The first year price is 100 at inflation rate of 6%. Therefore, 1.06 multiplied by 100 equal to 106. 106 multiplied by 1.06. That's 112. Whatever you have in your calculator multiplied by 1.06 equal 119. Okay. So let's say this is D. Then total variable selling and distribution costs in thousands. So that would be A times D. So what do you have? 100 multiplied by 100 will give us 10,000. Next one, 105 multiplied by 106. That's 11,130. Next one, 110 multiplied by 112. 12,320. And the last one, 108. 108 multiplied by 119. 12,852. So let's go and post. Total variable selling and distribution. 10,000 for the first year, followed by 11,130. 11,130. Year 4 is 12,852. That's working number 3. Then year 3 is 12,320. Twelve, 3, 2, 0. So I'm done with that. I will then go back to the question after variable selling and distribution cost. We also have fixed production cost for the year, 4 million. So fixed production cost in year 1 is 4 million. So I don't need to do working for this one. It's not related to units. All I need to do is just carry my calculator. Inflation rate on the production cost is 8%. Therefore, I'll bring out my calculator. 1.08 multiplied by 4,000 equal 4,320. 4,320 multiplied by 1.08 equal 4,666. What you have in your calculator multiplied by 1.08 equal 5039. Okay, so the next one, we also have fixed selling and distribution cost, 2 million at inflation rate of 6%. So fixed selling and distribution, 2 million for the first year. Inflation rate is 6%. So 1.06 multiplied by 2,000 equal 2,120 multiplied by 1.06, 2,247 multiplied by 1.06, 2,382. Okay. So that's that. The last one, fixed admin cost, 1 million at inflation rate of 5%. Fixed admin. $1 million multiplied by 1.05, 1050 multiplied by 1.05, 1103 multiplied by 1.05, 1158. I'm done. So I've considered all the relevant cash flow. At this point, I need to get profits. Because in this question, we have taxation. So I need to determine profits. Please add up the numbers. What do you get? Add up the numbers for the respective years. So I will do for year 3, 145, 530 minus 96, 250 minus 12320 minus 4666 minus 2247 minus, oh, that's an error. I made a mistake. 145, 550, 530 minus 96, 250 minus 12320 minus 4666 minus 2247 minus 1103 equal 28,944. 28,944. Kunle, are you there?
Year 1 is 28,000, sir.
Thank you. 28,000. I don't know where Tom Grace has gone to tonight. All of you are not giving me number again. Apart from only Joy was active tonight. Every other person you have gone on mute.
Year 2 is 28,630, sir.
28,630. 28. Sorry, my pen is not connecting. Come here. What's wrong with you? Okay. Yeah, hanging. Just give me a few seconds. Let me stop sharing this and share again. Sorry, let me just stop sharing. I don't know, it's not connecting with my pen. What's wrong with you now? Okay. Let me just save my work first. Sorry. My pen is misbehaving, it's not connecting. Let me I want to reshare again. Working note. Okay. Yeah, it's back. I don't know your problem before. Okay. Share. Sorry for the break in transmission. Yeah, Joy, you are giving me number. I said 28,
630.
630. Okay. Then year
That's
4,
26, 525.
525.
I got
That's
one.
Oh, yeah, no.
This one,
26,521. 521.
Yes, sir.
521. Okay, 012 low one. Okay. I thought it
yeah,
was 016. So
okay, 521. Okay,
Yes, sir.
so that's that. So this represents the profit. Immediately after profit, you are supposed to pay tax liability. So, and the examiner has told us that 30%, 50%, the tax rate is 30%, and the 50% of the 30% will be paid in the current year, while the balance of 50% will be paid in the following year. Because of this condition, we need to go and do working for our tax liability. Okay, so working number 4. Working number 4. First thing first, before you calculate your tax liability, you must estimate the capital allowance or tax saved on capital allowance, depending on what you want to use to reduce your tax liability. So I can say tax saved on capital allowance. Based on the formats that I gave to you last time. So the first item will be the year, then narration. We have the cost of the assets, then tax saved. Tax saved at the company tax rate of 30%. Figures are in thousands. So in year 0, we have the cost of the projects, which is 50, cost of the asset is 50 million. Figures are in thousands. So in year 1, the company will claim both initial allowance and annual allowance. But in this question, we don't have initial allowance, so you can claim annual allowance. So let's go back to the question. How are you going to claim your capital allowance? So according to the question, we are told that investment of this type qualify for tax depreciation. Tax depreciation is the same thing as capital allowance. So at the rate of 25% per annum on reducing balance basis. So capital allowance is on a reducing balance basis. That is, you are going to be multiplying the rates on the tax rated down value. So at 25%. So what's 25% of 50,000? That should be 12. Is it 12,750?
500.
500.
Sorry, 12,500. The difference would then be equal to 37,500. This represents the tax rated down value at the end of year 1. We'll move to year 2. Annual allowance at 25% of 37,500. What do you have?
9375.
9375 minus 37,500.
28,125.
28,125.
25.
So this tax rated down value at the end of year 2.
Yeah.
Moving to
Yeah.
year 3, annual allowance at 25% of 28,125.
7031.
7031. What's the difference? That's 21 or 20.
21094.
21094. So that's the tax rated down value at the end of year 3. Finally, year 4. Remember, the useful life of this asset is 4 years. So in the final year, you need to compare the tax rated down value from the preceding year versus the sales proceed. So year 4 being the final year, I can then say sales proceed or scrap value. Let's call it scrap value. We are told that the equipment will be disposed of for 1 million naira. Let me go back to the paragraph 1. So you are told in the question that at the end of this time, it has been agreed to sell the new production facility for 1 million naira cash. So that's the scrap value, 1 million. Figures are in thousand. So the difference between that will then give us the either balancing allowance or balancing charge, which is 20,094. That 20,094 is called balancing allowance. Okay, that's balancing allowance. When the tax written value from the preceding year is greater than the sales proceed, the difference is called balancing allowance. If otherwise, it is called balancing charge. So if that is the case, we need to calculate tax saved on capital allowance. Okay, let's calculate tax saved on capital allowance. The tax saved on capital allowance is computed as the company tax rates multiplied by the capital allowance computed. So we have calculated capital allowance for the first year to be 12,500. The company tax rate is 30%. That's 3,750. Here is 3,750. Again, 9,375 multiplied by 0.3 equal 2,813. Here is 2,813. The third year, tax saved is 7031 multiplied by 0.3 equal 2,109. Here is 2,109. Then the final year, 20,094 multiplied by 0.3 equal to 6028. Here is 6028. You may want to confirm if your total tax saved. You can confirm your total tax saved because you cannot claim more than what you are supposed to claim. Therefore, let's add up everything. 3,750 plus 2,813 plus
14,700.
14,700. This 14,700 has no value to whatever you want to do in your calculation, but just to confirm that you have not claimed more than what you are supposed to claim as in capital allowance. Therefore, to do this, total tax saved is equal to the cost of the assets minus the scrap value, okay, multiplied by company tax rates. So with this, here is 50,000 minus 1,000 multiplied by 30%. So I should have the same amount as 14,700. So this has given me the assurance that what I've done is correct. Okay, so that's the essence of using that formula. Other than that, it's useless. Okay, then. So now that I've calculated capital allowance as well as the tax saved, I can either decide whether I want to use capital allowance to reduce my tax liability or I want to use tax saved on the capital allowance to reduce my tax liability. Whichever one I use, I'm going to get the same answer. I will get the same answer. So if that is the case, let's say, for example, I want to use capital allowance to reduce my tax liability. Therefore, I need to go and calculate tax liability. This is working number 4, then we are moving to 5. Okay, working number 5. So I will say tax liability. I want to calculate tax liabilities for each year. So we have year 1, 2, 3, 4, then 5. Okay. So the first thing I will do, because remember what I said, the essence of capital allowance is to reduce tax liability. Therefore, I will bring out the profits. Profit for respective year. For year 1 is 28,000. What's the profit of year 2? 28 what?
630.
28,630. For year 3?
28,944.
944. Year 4 is 26 what?
521.
521. So that represents the profits. Ordinarily, I'm supposed to multiply company tax rates on the profits to get my tax liability. But because there is capital allowance, so I must first of all deduct capital allowance. If I want to use capital allowance to reduce my tax liability, I will first of all deduct capital allowance. I will then come here, capital allowance. So capital allowance we computed for the first year is 12,500. 12,500, here is 12,500. For the second year is 9,375, right? Is it? Let me check. Yes, 9,375, then 7031. Here is 7031, then 20,094. All right, so this will give me taxable profits. So here would then be taxable profits. So what's the difference? 28,000 minus 12,500. That's 22. What am I doing?
15,500.
Sorry, I've forgotten I have some figures on my. So 15,500. Thank you. Next one.
$19,255.
19,255. Okay.
21,913.
21,913. Then 6.
6427.
427. Thank you. So that's the taxable profit. It is on this taxable profit I'm going to pay tax. So examiner has told us that tax is payable at 30%. I would then say tax at 30%. So what's 30% of 15,500? 15,500.
4,650.
4,650. 4,650. 30% of 1922.
5,777.
5,777. Year 4.
1928.
1928.
Year 3. 6,574.
6,574. Okay. So if that is the case, now this tax liability of that we have computed at 30% for each year, that is not what you are going to represent. That's not what you are going to use, because the examiner has told you that 50% of your tax liability of 30% must be paid in the first year. Then in the year the profit is earned, then the following year you claim the balance. Therefore, I would then say the first 50% of the 30%. Then I also have the second 50% of the 30%. So I will add up the two together. Whatever I have thereafter will represent what I will claim, what I will charge. So I would then say tax liabilities. Okay, so let's get, what's 50% of 4,650?
2,325.
2,325. So the balance of that 2,325 will be paid in the following year. So here will be 2,325. What's 50% of 5,777?
2,889.
2,889. So the balance of 2,888 will be paid in the third year. Okay, you can't claim more than, you can't pay more than what you are supposed to pay. So by the time you have 288, it's 288, 2888.5. So you restrict
Yes,
our
sir.
number. So Yes, the next one, 50% of 6574.
3287.
3287. Then this one will be 3287. It's even. Then the next one, 50% of 1928.
964.
64. Then 964. So let's add it up. 964, 2323. Then here will be 515214. Here will be 6175. I hope I'm correct. Here will be
Yes, sir.
4. Here will be 4241. Is that correct?
4251.
Okay, 4251. Thank you. So that's the tax liability we are going to charge. So let's go and put it there. Sorry, this is not correct. This is 5. So 2325 for the first year. So I would then say tax liability. Let me shorten it. Tax liability. Working number 5, I think. Here is 2325. The second one, year 2 is what?
5214.
5214. Next one,
6175.
6175. And the year 4,
4251.
4251. Year 5,
964.
964. So that's the tax liability. In this case, we use capital allowance to reduce our tax liability. Okay? We use capital allowance to reduce our tax liability. Using capital allowance to reduce tax liability. That's what we did here. If I want to use, because of time, if I want to use tax saved on capital allowance, I will not do it this way. If I want to use tax saved on capital allowance to reduce my tax liability, I will not do it this way. For those of you that have the ebook, you will see in that one, I use tax saved on capital allowance to reduce the tax liability, but it's the same thing you are going to get, okay? But because of time, well, let me see. Let me first of all complete the question, then we'll come back to that. Somebody should remind me later on. So after the tax liability, I need to consider scrap value. So because I used capital allowance to reduce my tax liability, so there is no need for you to come and put tax saved on capital allowance again. If I want to use tax saved on capital allowance to reduce my tax liability, there is a way I will treat it, like I said the other time. So, but again, I will show you later on, but for now, let's move on. Scrap value is 1,000. Then we have initial outlay. Initial outlay is 50,000. According to the question. So we don't have working capital. So you ignore working capital. So at this point, let's find the net cash flow. Give me the net cash flow.
50,000. Yes, 0.
That one is glaring now. 964. Yeah. 5. No. 4.
256675. Year 1.
Year 1 is what?
25675.
No. 28,000. You said 25.
675.
675.
Yes, sir.
Oh, okay. No, that's not correct now. It has to be 24. 28,000
Eh,
minus 2325.
Yes, sir. It's 25675.
Uh, 28. No. Let me see. 28,000. It's not adding up to my eye. Minus 2325. 25. You are correct. So my mind is on the fact that if I had the two, it will give you 29,000. But in any case, let's move on. What's the next one?
23416.
23416. Next one.
22769.
22,769.
23270.
270. Thank you. So
Year
now
three.
that year three
Okay,
is what?
23. Yeah, it's correct, sir.
Okay. So after the net cash flow, we need to discount. I will then go to the question, what's the cost of capital given to us? According to the question, you are given a cost of capital of 12%. So examiner did not tell you anything about the cost of capital. Remember, I mentioned to you money cost of capital, real cost of capital. I said that money cost of capital is the cost of capital that include the impact of inflation. So except examiner says otherwise. In this question, the 12% given to you as cost of capital, examiner did not mention anything, whether it's a real or is in real time. So it is assumed to be money cost of capital. Okay, that's the money rate of return. So there is no need to go and do any calculation again. So if that is the case, so
Can
at
you explain that
12%,
again?
what we are saying is that if you are given the cost of capital, no further explanation, just given cost of capital, like in this case, that cost of capital is money cost of capital or money rate of return. But if you are given cost of capital and an examiner mention if you are given real cost of capital, then you need to convert it to money cost of capital. So like in this question, 12%, 12% discount rates. So no further explanation. So it means it's a money cost of capital. So do nothing. So 1.12 raised to power 1 minus equal 0.893.
0.893.
893. Then year 2,
0.797.
797.
0.712.
712.
0.636.
36. 0.5.
567.
67. Okay, so that's that. So we need to get the present value. Here is 50,000 for year 0. Yes. What do you have?
22,928.
22,928. Yep. Next one.
18,663.
18,663.
16,212.
16,212.
14,800.
800.
547. Brackets.
547. Okay, final answer. Add up the positive present value net of the negative present value. What's the final answer? The negative is 50,547. So positive minus negative, what do you get? That's 20 what?
Okay, 2056.
22,056, correct. So in this case, in number A requirement, examiner is asking you to advise Kilimanjaro PLC whether the investment is financially worthwhile. I would then say the investment is financially worthwhile, considering the positive NPV of 22,056,000 naira. Therefore, hence, the investment should be accepted or undertaken. Okay. At this point, this is not sufficient. It is not sufficient for you to have done this. For you to be able to earn your entire 17 marks, you need to state your assumption. Okay? You need to state all your assumptions because there are some cash flows in the question that you ignore. You know, in the first question that we solved, that Maryland question, we did not state the assumption. So it is expected that you must state your assumption. So whenever you want to state assumption, you can talk about cash flows. If in the question, what's the assumption on cash flow? Let's take it one by one. So you can say that it is assumed that, okay, it is assumed that the cash flow estimates, okay, the cash flow estimates are realistic. And will occur at the end of each year. So if you want to go further, you can state that all cash flow have been inflated at the appropriate inflation rates. Then number two, you can talk about cost of capital. So what's the assumption on that? It is assumed that the cost of capital of 12% is appropriate and consistent with the cash flow and the risk associated with the projects. You know, I mentioned to you when I was explaining the concept last time that I gave you a general rules that you must apply in relation to inflation. Money cost of capital for money cash flow, real cost of capital for real cash flow. So the cash flow given to us in the question are real cash flow. So we converted it to money cash flow. So you must use cost of capital that is consistent with the cash flow. And that's what we have done. Then assumption number three. Assumption number three, you can talk about inflation. Examiner has given to us inflation rates. So what's the assumption on inflation? So it is assumed that the inflation rates will remain constant within the relevant range. Okay. It is assumed that the inflation rates will remain constant okay, within the relevant range. Okay, that is for the period under consideration. So it will not change because, for example, if the inflation rate on the cost increase, then the decision to accept the project may be impacted. Then number 4, we can talk about sunk costs. We have 2 different sunk costs. So we have development costs and market research costs. You can then say the development costs of 2.5 million and markets research costs of 1.5 million naira are sunk costs. And therefore irrelevant to the calculation.
That is related to the first question.
Number
Hello, sir.
What are you saying?
I said the sunk cost is related to the first question on Maryland.
Oh, okay. This one is now, let me check. Oh, it's true. I was using, my mind is still on. Okay. Yeah, correct. So there is no sunk cost in this one. In any case, so what do you need to do now? Just replicate all these assumptions I just mentioned, replicate it to the first question. Then in this second one, remove the sunk cost. Okay, I think we don't have any sunk cost in this question. So all the cash flows are what we use. All right, so that's that. That's basically that. All right. So I hope you'll be able to get the last, because I want to clean the last one so that you don't make a mistake on that. So there's no sunk cost on this question of Kilimanjaro. We only have sunk cost under Maryland Company Limited. So this last one should be taken to the first 4 assumptions should be taken to Maryland, but the first 3 is for was Kilimanjaro. So that's that. Then lastly, number B, you also have to calculate internal rate of return. Okay. Internal rate of return. Number B, calculating. Will this page be sufficient for me? Let me go down there. So let's calculate internal rate of return briefly. Number B, calculating internal rate of return. You know, whenever you want to compute internal rate of return, you are expected to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV. The second discount rate will give you a negative NPV. Then you interpolate into the IRR formula. That's all you need to do. But when you look at the NPV we computed, you will notice that our NPV is so huge at 22,056,000 naira. That's a very huge one. We use 12% to get that NPV of 22,056. So what that simply means is that even if you assume 15, 20, 25% to calculate your IRR, you still be having a positive NPV. So to be, whenever you want to compute internal rate of return, okay, you have to check the size of your cash inflow and the cash outflow. If your cash inflow is almost double your cash inflow, then in that case, it is important to start with a very high discount rate. Like in this case, when you add up the present value of cash inflow, when you add them up together, it's almost double that's about 80 something thousand or thereabouts. Okay, almost double the initial outlay. So in this case, let's assume 30% and see what we are going to get on our IRR. So I will teach you exam method. So instead of having different table for positive and negative, use only one table. So here, cash flow, discount factor, at then present value. Okay. So let's start with 30% first. Okay. Year 0, 1, 2, 3, 4, and 5. Cash flow, give me the net cash flow. Here is 50,000. Net cash flow of year 1 is what?
Net cash flow 25,675.
25,675, correct. 25,675. Here is 25,675. Year 2.
23,416.
416. Year 3.
22,769.
769. Year 4.
23,270.
270. Then year 5.
964 negative.
964. So let's calculate discount factor for year 1 at 30%. Okay.
0.769.
0.769. Year 2.
0.592.
592. Year 3.
0.455.
455. Year 4.
0.350.
350. Year 5.
0.269.
269. So let's multiply to get the present value. Here will be 50,000. Year 1.
19,744.
19,744.
13,862.
13,862.
10,360.
10,360.
8145.
Okay. 8145. So let's add it up. So 19,744 plus 13,862 plus 10,360 plus 8145 equal minus 50259.
2122.
212, no, minus 259. You have not done that. That's 1852. I got 1852 positive. Do it again, Kunle. It's like you did not include the last one.
I did.
Okay, let's do it again. 19,744 plus 13,862 plus 10,360.
Okay, you are right, sir.
Okay. So we assume 30%, we got a positive NPV. Let's assume a higher discount rate. So you can see that this NPV of 30% is closer to 0, 1852. So let's assume 35% and see if we are going to get a negative NPV. So giving a discount factor at 35% for year one.
0.741.
0.741, 0.5, year two,
0.549.
549, year three,
0.406.
year four,
0.301.
0.1, then year five,
0.223.
2, 2, 3. So let's multiply that with the cash flow. I'm not sure there are other people on this line. It's only you. No worries.
19,025.
19,025.
We are here. Oh. We are here.
I'm not sure you are there. If you are there, you give me numbers. Yeah.
12,855.
12,855.
9244.
9244.
7004.
7004. Oh, you are back. That's good. The
215.
last two, 215. The final answer, MPV. Yeah.
Minus 2087.
Minus 2087. So we assume 30%. We got a positive NPV of 1852. Then we increased to 35%. And we got a negative NPV of 2087. Therefore, we then proceed to calculate internal rate of return, which is lower discount rates plus the NPV of the lower discount rates divided by the NPV of the lower discount rate plus NPV of higher discount rates. All of this multiplied by higher discount rates minus lower discount rates. So internal rate of return, 30% is lower. So 30 plus NPV of the 30 is 1852 divided by 1852 plus NPV of higher 2087, I think. Yeah, 2087 multiplied by higher of 35 minus lower of 30. Final answer, what do you get? So 1852 1852 plus 2087 equal 3939. So 1852 divided by 3939 equal, multiply by difference between 35 and 3, which is 5, multiply by 5 equal, plus 30 equal 32.35%. Here is 32.35%. Therefore, internal rate of return is approximately 32%. That's it. That's it. You can see it's a very big question. So you have to sweat for you to be able to hang the entire 30 marks. Okay. So when you are faced with this kind of a question, you have to be very careful. So you have to be very careful because your target should be that you want to hang the maximum mark as possible. So in that case, you go for section B or section C, look for any cheaper questions that you can solve within 30 minutes or thereabout. Then come and waste your time, 1 hour, 1 hour plus, whatever. Come and waste your time on the compulsory question. Take your time, review, articulate it, understand it, then find a way. Just ensure that you maximize your score, okay? Because you don't make it your first attempt. If you make it your first attempt, it may throw you off balance. And when that happens, then you struggle to solve two questions in section B and C. So that's a recipe for failure. Please, don't always make compulsory question your first attempt. So, all right then. So in the other part of the question, let me stop sharing this. Let me know if you have any question on this before I change to the other side. If not, I will stop sharing. Okay, let me review some of you. Ajay, you are just there. No comments, nothing, no participation. Abdulatif is not here today. Ahmad is not online today. No worries. Congress has been on leave. She did not communicate and participate at all, except when she has questions. Toyib, Yusuf.
Excuse me, sir.
Yes, talk to
You
me.
said you were going to tell us how to easily know what percentages to use for the discount rate to get the IRR, one that give us positive and negative. Like, how did you get 30 and 35?
I've already said it. You are just going to assume now, you know, when you are calculating internal rate, you are the one that will assume the discount rates. So nobody will, so you are supposed to assume the discount rate yourself. So that's one of the disadvantages of IRR, because it is subjective. So whatever you think is the rates, just assume 2 discount rate that will give you 2 opposing NPV. That's all. Yeah. So what I'm now saying is the fact that the size of your cash inflow relative to the cash outflow will depend on the rate that you are going to, the rates that you are going to assume. All right. So if the size of your cash inflow is higher and almost double the cash outflow, then you may assume a higher discount rate for the purpose of getting a negative NPV when calculating internal rate of return. Okay, so because of time, you're welcome. So please, I need you to go ahead in the for those of you that have access to the ebook. So I mentioned the other part, if I want to use tax saved on capital allowance to reduce tax liability. All right. So the way I treated it in that one, even though we got the same answer, the way I treated it in the ebook is different from in this particular illustration. We use capital allowance to reduce our tax liability. In the ebook, I use tax saved on capital allowance to reduce tax liability. So whichever one you use, we are going to get the same answer. But time will not permit me now to be demonstrating the two together. So I'll be very happy if I can solve one more illustration for you. So that will be the end of it. Well, okay, let's do it this way. Let me even share so that if possible, I can have one or two more illustrations using the ebook. Now, let me stop sharing this first. Let's go back to the question. So number C part of the question, you have to define the following: real rate of return, money rate of return. So in our previous class, we've already explained this. The real rate of return is the same thing as money cost of capital or money discount rates. It is, sorry, real rate of return is the same thing as a money rate of real cost of capital or real discount rates. So it is a cost of capital that is stated in real terms. Okay, real rate of return is the rate of return that is stated in real terms. The other one is money rate of return. Money rate of return, also known as money cost of capital or money discount rates, is the rate of return that is stated is a rate of return that include the possible effect of inflation. Okay, it's also known as money discount rates, money nominal discount rates. Okay, so that is for that. Then the last one, number D or thereabouts, you have to explain briefly how real rate of return and money rate of return will apply in calculating the net present value of the project cash flow. That's very simple. Examiner is just telling you to explain the rules, the underlying rules in relation to inflation. So your response should be that in the calculation of the NPV above, money cash flow, the money discount rate of 12% was applied to discount the money cash flows. Okay, then real rate of return should also be used for real cash flows. That's what examiner is asking you. Just remark, pocket it. The entire 30 marks, there's nothing stopping you from scoring 25 marks and above. If you score 30 marks, that's good. Excellent. Okay, then. So,
Hello, sir.
yes, talk to me.
I'm still confused about how to identify the money cash flow. I mean, distinguish between the money cash flow and the real cash flow.
How to distinguish?
Yes, sir.
What do you mean by how to distinguish?
I mean, how to identify which one is the money cash flow, particularly in the question, and which one, I mean, when it's real cash
Only
flow.
you're on your own, no.
I'm
Only
confused, sir.
How are you confused?
That's the essence of the class, sir.
I told you this is not a matter of essence of the class. Specifically, I told you, I even said it today. Last week, I mentioned to you, when I was explaining inflation, I also said it today. If cash flow are stated in year one prices or first year prices, inflation should start from once you are given when I was explaining inflation, money cost of money cash flow and real cash flow, I said money cash flow are cash flow that include the possible effect of inflation, isn't it? And I said, except examiner says otherwise, all cash flow are assumed to be money cash flow. So if you are given cash flow in the question, no, you are not told whether it is in year one prices or current value terms, you should know that it's a money cash flow. But the real cash flow are cash flow that are stated in today's prices, year zero prices, or first year prices. They are cash flow that does not include the possible effect of inflation. So once you are given cash flow and you are told that they are in current value terms or in today's prices or year one prices, that is real cash flow.
Yes, sir. Thank you, sir.
You're welcome. So, yeah, I would have loved to solve illustration number, let me see, illustration number 2, Orimolade. This question on Orimolade, okay, let's do it this way. Let me see if I can let me stop sharing this and use the other one. Let me see. Let me use the ebook. so that for the remaining minutes that we have, I should be able to complete it. Okay. Let me see. Because if I were to solve that question, it will take me for additional 45 minutes. And once it is 11 o'clock, some of you will disappear and leave me alone. Okay. Let me see that question on Orimolade. Where is it? Okay, this is it. Yeah. So it is Zambezi. So now I need somebody to read this illustration. In fact, because of time, let me read. So this is the same question you have in your material as Orimolade, but here is Zambezi. Zambezi Limited is currently considering two mutually exclusive investment projects. Both projects are concerned with the purchase of a new plant. The company made available the following data for each project. Okay. Zambezi Limited has an estimated cost of capital of 10% and employs the straight line method of depreciation for all fixed assets when calculating net profits. Okay. Neither project will increase the working capital of the project of the company. The company has sufficient funds to meet all capital expenditure requirements required. A, calculate for each project. 1, the net present value. 2, the approximate internal rate of return. 3, the payback period. 4, the accounting rate of return. B, states which, if any, of the two investment projects the company should accept and why. So that is the question. So this question look very simple and straightforward, but examiner has put in a bit in the question such that an average student, if particular attention is not paid to the figures given to you, you may get it wrong. You might have spent about 30 minutes or thereabout to solve the question, even more to solve the question, and then not knowing that you've already committed a very big error. So when you look at the figures given to you, remember when I was explaining a payback period, NPV, internal rate of return, I mentioned to you that all those techniques, you are going to use cash flow. You need cash flow. But for accounting rate of return, you need accounting profits. So in this question, examiner has given to you expected annual profit or loss, expected annual net profit or loss. So all the figures that you have in this table represent profit or loss. And you don't use profit or loss to calculate NPV, IRR, or payback period. You need cash flow. So here, profit or loss have been given to you. So you need to convert it to cash flow first before you calculate your NPV, IRR, and then payback period. The only technique that you can use all these figures for directly is the accounting rate of return. Okay. So if that is the case, how do you then solve the question? The first thing you are going to do in solving this question is to go and do your workings. You need to convert this accounting profit or loss to cash flows first. Before you be able to do that, you also need depreciation, because cash flow is accounting profit or loss plus depreciation. When you want to convert profit to cash flow, so you need to add annual depreciation, you add it to the annual profit or loss. So in this case, the first working you are going to do should be the depreciation. So you calculate depreciation for each year. Once you have that ready, then you now proceed to calculating the cash flow. So cash flow will then be equal to profit or loss plus depreciation. Once you have the cash flow ready, you can then go ahead and calculate the NPV. So let's see how we solve this, how I solve this question. So first thing first, you need to go and do your workings. So let's go to workings. Okay. Let's go for workings. Yes. So working number 1, is to calculate annual depreciation. And you know that depreciation is initial outlay minus scrap value of the project divided by the useful life. For project A, initial outlay for project A is 200,000. Scrap value of project A is 14,000. 200,000 minus 14,000, that's 186,000 divided by 3. That's annual depreciation for project A is 62,000. I will also calculate depreciation for project B. Initial outlay of project B is 120,000. Scrap value of project B is 12,000. 120,000 minus 12,000. That will give us 108. 108 minus 3 will give us the 36,000 naira. So we have calculated annual depreciation for each project. Then the next thing we want to do, the next working is to calculate cash flow. And I said that cash flow is computed as accounting profit or loss plus depreciation. Accounting profit or loss plus depreciation. So you are going to do for each project. So for project A, according to the question, the first year profit is 58,000. Second year, we are given a loss of 2,000. Third year, we are given a profit of 4,000. Then annual depreciation we computed is 62,000. So 58 plus 62 will give us 120,000. Minus 2,000 plus 62,000 will give us 60,000. 4,000 plus 62,000 will give us 66,000. So that is the cash flow you are going to use for project A to calculate NPV, IRR, then payback period. You do the same thing for project B. The first profit given for the first year profit for project B is 36,000. You are given a loss of 4,000 for year 2, a profit of 8,000 for year 3. Annual depreciation is 36. Add it up, that's 72 for first year. Minus 4,000 plus 36 will give us 32,000. 8,000 plus 36 will give us 44,000. So now that you have the cash flow, you can then proceed to calculate NPV. So let's go and calculate NPV for each project. Bear in mind that these are our cash flow that we are going to use for project A and B. So let's go up there and see how we calculate the NPV. Because in this particular question, so there's no, you are not expected to use the, you are not expected to use columnar format because the very simple kind of information given in the question is not a multiple variable. So just cash flow and that's all. So for project A, we want to calculate NPV. So just like we have done previously in the calculation of the NPV. So for this project, initial outlay is 200. Cash flow, cash inflow for year 1 for project A is 120. Year 2, 60. Year 3, 66. Year 4, year 3, we have scrap value. Okay, scrap value. So discount factor at year 0 is 1, year 1.909, year 2.826, year 3.751. So multiply that to get your NPV. So NPV of project A is 18,720. You do the same thing for project B. For project B, the cash flow of project B initial outlay is 120. In year 1, we calculated cash flow to be 72. Year 2, 32,000. Then year 3, 44,000. Of course, scrap value at that year 3 is 12,000. So you multiply with the discount factor and we got NPV of 13,936. 13,936. So that is, we are done with NPV. We then proceed to calculate internal rate of return. And you know that whenever you want to compute internal rate of return, you are expected to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV, another discount rate will give you a negative NPV. Therefore, first thing first, we assume 15%. Okay, we assume 15%. We still have the same cash flow. So discount factor at 15% for year 1 is 0.870, 0.756 for year 2, 0.658 for year 3, and then multiply with the cash flows. So we got NPV of 2,400 positive. C, you can't just increase because you are looking for negative NPV, because majority of you, your intention will be that since you have calculated NPV previously, 18,720, 13,936. So your focus is to now increase your discount rate from 10% to 100% or 10% to 20%. So it doesn't work that way. It's not realistic. It's not attainable in the market. So the difference between the two discount rates you are going to assume should not be more than 5%. If your first discount rate that you assume is 5%, you can increase to 10%. If the first discount rate you assume is 10%, you can increase to 15%. If the first one is 15%, you increase the second one to 20%. You can't just increase from 10 to 20 or from 20 to 30. It doesn't work that way. At this level, maybe at foundation or skills level, examiner can pardon you. Examiner can pardon you, but at professional level, you should because that rate is not attainable. You can't get such a rate in the market. You can't just increase 100% just like that. It's not achievable. Okay, so we have to be realistic. All right. So, but in any case, let's move on. Now, so for project B at 15%, of course, the cash flow still remain the same. Discount factor still remain the same as we did for project A. We use this to calculate the NPV, and we got a positive NPV of 3,680. So we assume 15% for project B, and we got a positive NPV for both projects A and B. So in this case, we need to increase the discount rate to get a negative NPV. So therefore, let's assume 20% as shown in this material. Okay, so the discount factor at 20% for year 1 is 0.833, year 2 is 0.694, year 3 is 0.579. Okay, multiply that with the cash flow, you get the present value. So present value minus present value of cash inflow minus the present value of cash outflow of 200, we got 12,080. So you notice that this 12,080 is even huge, is big, which means that if we assume something like 18%, we should be having a negative NPV as well. But to be on the safer side, difference of 5% is ideal. So we are okay, we are good to go. All right. So for project B, cash flow still remain the same. Discount factor as you have for project A, then you multiply that to get the present value. At the end of the day, we got a negative NPV of 5,392. So we assume 15%, we got a positive NPV for both projects. We increased to 20%, we got a negative NPV for both projects. So the next thing we need to do is to calculate internal rate of return using the IRR formula. So put the variables in the IRR formula. For project A, we got 15.83, okay? 15.83, which is approximately 16%. For project B, you put the variables, the NPV of cash inflow, sorry, the NPV of lower discount rate and the NPV of a higher discount rate. This one's supposed to be 5392. So this one will be 17.03, I think, 17.03%, approximately, yeah, 17%. So it's a typo error, okay? Transposition, what do you call that error in financial accounting? Okay, then. So that is that. That is how to calculate internal rate of return. That's how to calculate internal rate of return. The next one, you have to calculate payback period, okay? So to calculate the payback period, these are the cash inflow. You know that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. So all the cash inflows of the project A is what we have here. So how do you do this? You then, of course, you create this format, this table, all right? So in year 0 is 200,000. So 200,000 minus 120 in the first year will give us balance of 80,000 in year 2. 80,000 minus 60,000 will give a balance of 20,000 at the end of year 2. So which means that we have recovered 180,000 out of the 200. So we have a balance of 20,000 naira to recover on project A. So when you get to a point where your outstanding balance is lower than the next cash inflow, you put a dash. 20,000 is lower than 66,000, you put a dash, and you calculate the payback period. So we have recovered for 2 years. Outstanding balance is 20,000. The next cash inflow is 66,000. Put it in your calculator. We got 2.3 years. Then we do the same thing for project B. Project B, initial outlay is 120. 120 minus 72,000 will give us a balance of 48,000. 48,000 minus 32 will give us a balance of 16,000. 16,000 is lower than the next cash inflow. You put a dash, then you calculate the payback period, and we got 2.36 years. Okay, we got 2.36 years. All right. So finally, we need to calculate internal. So we need to calculate accounting rate of return. We calculate accounting rate of return. So you know that accounting rate of return, also known as return on capital employed or return on investment, is a technique that relies heavily on the use of accounting profits. For the use, it relies heavily on the use of accounting information as shown in the financial statement of a company. So in this case, when you want to, examiner has made life so easy for you in this question because already you have accounting profit or loss. So in that case, all you need to do is to go ahead and calculate your depreciation because you already have depreciation. So in fact, you don't even need depreciation again because you are not using cash flow to get your accounting rate of return. So all you need to do is to just add up, as given in the question, you add up the accounting profit or loss for each year, add all of them together, that will give you total profit. Then you divide it by the number of years. So that will give you average annual profit. So first thing first, before you can get your accounting rate of return, you need to go and calculate average annual profit. You also calculate average investments. So once you have it done, then you come and put it in the formula. Okay, that's that. Then let's go and do working for that. Briefly, I think I've done, yes, I have it here. This is it here, average annual profit. So all you need to do, like I said, add up the accounting profit or loss for each year. Okay, add all of them together. Then 60,000 divided by 3 will give you 20,000 for project A. That's average annual profit for project A. Do the same thing for project B. 36,000 minus 4,000 plus 8,000. Okay, we give you I think that's 40,000. 36 minus, that's 40,000 divided by 3. That's 13,333. So that's average annual profit. I will then calculate average investment. Average investment is initial outlay plus fair value divided by 2. So we got 107 for project A. Average investment for project B is 66,000. At this point, I can then go ahead and calculate my accounting rate of return. However, if in the question I'm given cash flow, and if I'm given cash flow, I can't just, my average annual profit will still be the same thing, but not like this. First thing first, I have to create a column for cash flow. I'll create a column for annual depreciation. Then I'll create a column for profits. So cash flow minus depreciation will give me profit or loss. I'll do for year 1, do for year 2, then I will do for year 3. I need to get the total profit. To get the total profit, just add up the profit alone. That's the total profit. You don't get the average profit. So the average annual profit will then be equal to the total profit divided by the useful life. That's what you need to do. If you are given the cash flow, it's still the same thing. So, and that's what we didn't do that in this one because we are given accounting profit. So put it in the formula of accounting rate of return. Average annual profit for project A is 20,000. Average investment is 107. So at the end of the day, we got accounting rate of return of 19% approximately for project A. We got 20% for project B. That is it. So finally, what you need to do now is to put your answer in a table because you have used NPV, internal rate of return, payback period, and accounting rate of return. To have a good presentation, just put all your answers in a summary of table. Okay? So using this format, so create a column for the project, create a column for the methods that you have used, like NPV, IRR, payback period, accounting rate of return. So all the workings, all the calculations that you have done for project A under NPV, what do you get? For project B, what do you get? At the end of the day, which of the two projects are you going to select for between project A and B using NPV? Project A has a higher positive NPV. You select project A. Under IRR, IRR of project A is 16%. Project B is 17%. Project B is higher than project A. So therefore, we selected project B as for IRR. Then for payback period, you select any project with a shorter payback period. Project A has a shorter payback period of 2.3 years. Therefore, project A is selected. Under IARR, you select any project with a higher ARR consistent with the management predetermined ARR. So project B has a higher ARR. That's why we selected project B. Okay. So this is what you need to do. This is what you need to do as far as decision rule is concerned. Therefore, examiner is not asking in the question. Examiner is asking you to advise which of the two projects to be selected and the reason why. At all times, whenever you want to make a decision between NPV and any other technique, your decision should be based on the net present value. Why? Because NPV is a technique that is consistent with the shareholders' wealth maximization objective. It is believed that a positive NPV will increase the value of the company and which will invariably maximize the wealth of the owners. So project A and B, when you look at the calculation that we have done, you will notice that project A and B are financially viable using the NPV because the NPV of project A is 18,720, okay, and that of project B is 13,936. So the two of them are financially viable. However, since the two projects are mutually exclusive, remember, a mutually exclusive project are competing projects in which the acceptance of one will preclude the acceptance of the other. If you select a particular project, you are going to reject the other project. So since project A has a higher positive NPV, then project A should be selected and you reject project B. That's that. However, the selection of project A over project B is based on NPV criterion. This is premised on the fact that NPV criterion is in consonance, okay, is consistent with the objective of shareholders' wealth maximization, okay? It is generally believed that a positive NPV will increase the value of the company and which will invariably increase the wealth of the shareholders. Thus, the NPV technique is more reliable relative to other methods such as IRR, payback period, or accounting rate of return in the ranking of mutually exclusive projects. So that is it. That's the question. So for those of you that have the ebook, so you can go ahead, go and solve more. There are so many illustrations in the material. So this is Cincinnati. This is another scenario-based question. So check the solution, solve the question, practice the question, then check the solution. Then particularly this illustration number 3, ensure you try it. Go and try this illustration number 3. So this one, the cash flow given to us are in current value terms, meaning that they are real cash flow. Okay, your inflation should start from year 1 in this case. So check the solution, how I treated it, so that you can gain more insights on the topic. All right. So make sure you go through it. Make sure you go through it, master it. All right. So that's basically that. That's basically all those assumptions I was trying to mention. The assumptions are consistent all throughout. Whenever you under capital budgeting, the assumptions are almost the same thing. So nothing different. Okay. So that will be that. Let me know if you have any question for me. Let me know if you have any question for me. All right. So if there's no question, you remember today is the last lecture day for this. Yeah, thank you, Karade. So today is the last. Yes, talk to me.
Okay. Thank you very much for the class. My question is that you said something about for the sake of the exam. You said we should always starts from section B
Or
um
C.
or C. So what if that section A, like you know it very well, is it advisable to just do it once and for all?
Section A is a compulsory question and it's 30 marks. No matter how easy it is, it will take time to, if you know that you are not going to spend more than 30 minutes or maximum 45 minutes to solve that question A. Maybe you are lucky, maybe it's something that has been tested before or a question you are familiar with, then you now meet it on the day of your exam. When you see something you are familiar with, it won't take time for you to solve. Okay, in that case, no issue. But if it's a question that you're just seeing for the first time and you know that is a big question for that matter, it's going to waste. Don't make it your compulsory question. I mean, don't make it your first attempt. Otherwise, it will throw you off balance. You will think you may be getting it, you'll be doing it, and you'll be enjoying it, but you will not know that time is already is going. So before you realize, you might have spent hours and you are still on that same question. You'll be solving 1 page, 2 pages, 3 pages, 4 pages on that same question. You'll be happy. Oh, you are doing something. Until the invigilator will tell you that 30 minutes more, and you know that you still have about 4 more questions to solve. So how do you want to do it? 30 minutes for 4 questions. And that's why it is important that you go to section B or section C. Go and look for any questions that are, start with the simplest question, okay? The question you can solve within 20 minutes or maximum 30 minutes. You can pocket about 2, 3 questions that are very straightforward that you can solve within few minutes. Then you can come and spend sufficient time, okay, to battle the compulsory question which carry the highest mark. Okay, so you have to be very strategic in the way you attempt your question, because if you get it wrong at the first instance, forget it will take you a miracle to pass that paper. All right, so yeah.
All right. Thank you very much, sir.
You're
Then
welcome.
the first question you solved, that's working number 1.
Yeah.
Please, do you still have the screen with you, sir? I want to screenshot I did not
No
read.
worry,
I did not
I will
get.
share it. I will share it.
Okay,
The
sir.
one on
Thank you very much.
Maryland, right?
Yes, sir. Yes, sir.
I will share. No worry.
All right,
Okay.
sir. Thank you very much.
Yeah.
Yes, sir.
So, in the absence of no question, I need to advise you for the remaining days. You have about 22 days now. Let's say today is gone, 21 days or thereabouts to the D-Day when you are going to have your exam. Please, guys, there's no time for you again to be gallivanting around. You need to be more focused and serious for the remaining days you have to the D-Day for the exams. So what I mean by that is the fact that you need to be more committed, okay? You know that you have a goal that you want to achieve. Your high-can goal for this November diet is to clear your papers. Whatever the number of papers that you want to write, your goal is to pass them all. Therefore, whatever it will take you for you to be able to achieve that, you have to give it. You are going to deny yourself some benefits. You are going to make some sacrifices, in the sense that if you have been sleeping for 5 hours for some time now, since you have started reading for your exams, for your ICANN exam, so you have to reduce your sleeping time, maybe reduce it to 4, so you spend more time to studying. Now that you are done with lectures, Saturday and Sunday, you must devote that day fully. Devote that day fully to studying. If your home is too comfortable for you, go to the library or go to any school around you where you can read. Any conducive environment where you can read. Okay, you can read satisfactorily, such that at the end of it, when you read, you have a quality time. Of course, you'll be happy with yourself with what you are going to gain on that day. So for the remaining 2-3 weeks that you have now, so spend those periods if you are, for example, as a working class, maybe you get home very late in the night, So at that point in time, you may not be able to achieve anything if you say you want to read because you're already worn out. So what that means is that you have to wake up very early in the morning and pick your books, okay? Wake up very early in the morning, around 2 or 3 a.m., take your shower, prepare as if you are going to the office, then carry your books and read until you are going to leave for office, okay? So if you can do like 2-3 hours by that time on a daily basis, do 2 to 3 hours. So of course, you are going to be happy with what you are going to gain during those periods. So please, guys, I want to encourage you to be more committed because you are seeing your ICANN go now because you are going to a war with ICANN. ICANN is aware of the fact that you will be attending lectures and they are waiting for you on that day, on the day of your, on that exam date, that you should come and defend. You say you have gained so much knowledge, you have been trained, yeah, come and demonstrate that you have the requisite knowledge. So, and yes, that means you are going to a war with ICANN. So I want to encourage you guys, double your effort, be focused, be determined on the exam that you want to write because you have sacrificed a lot. You can imagine you go to work Monday to Friday, okay? Instead of you to relax when you get back, when you get home in the evening, but you, because of ICANN, you couldn't relax. You have to attend evening class, you know, very strenuous. Some of you maybe even be sleeping in the class unknowingly because you're already worn out. So what will be the impact? I mean, what will be the value at the end of the day if you can? What will be the reward if you can't make your results? I mean, you can't pass your exam. And therefore, that's what I'm encouraging you to double your effort for the remaining days that you have. Read as if tomorrow is the exam. Read as if tomorrow is your exam so that you can gain something, you can get value for and you get reward for all your effort. You can imagine effort, I mean, reward of, I mean, the stress of Saturday and Sunday included, you know, Monday to, in fact, it's even Monday to Sunday. Please, I beg of you, take it very seriously. ICANN exam is not difficult. I can bet you it's very easy to pass. Only if and only if you know what you are doing. There's no how you are determined, you are focused, and you read very well that you are not going to pass. No, except you made a very costly mistake, and you can't make mistake for all the questions. That's not possible. So please, guys, take your time. So whenever you are given a question, don't just jump to solving the question. You have to articulate your points. Ensure that you understand the requirements of the examiner before you put your pen to paper. Because once you rush the question, you could have gone far before you realize your mistake. So take your time, articulate on how you are going to present your work before you put the pen to paper to begin to solve the question. And I pray that God Almighty will make this exam that you want to write very easy for you. It will guide you aright and shift your focus to the areas of the syllabus where examiner will test on that day. So, as you are aware, today is the last lecture day. We started since July 1st. So today is the last day. Yeah. So that is that from me to you. Thank you guys for your understanding and patience. You know, at times I can be stubborn in class, especially if I ask you, if I tell you not to make noise or mute yourself and then you are not listening, maybe unintentionally, you know, you put on your speaker, you know, I can bounce on you. When I do that, I usually want you to get serious. That's why, please, if I've offended you in any way or the other during the course of this class, please forgive me, all right? It wasn't intentional. Okay, guys, thank you. We expect to get the best from you. Please, all eyes are on you at Equity. Our intention and our plan at all time, our goal is to give the best to all our students. Our goal is to ensure that all our students succeed, okay? Therefore, all eyes are on you. It is possible, like we have said previously in one of our classes, your result may be released few days to the Christmas. So for this November diet, your result may be released few days to the Christmas. So what that simply means is that you have to make it a double joy. So you can imagine if Christmas is on the 25th 25th, and your result is released on the 13th, on the 23rd or 22nd. So if your result is good, you can be rest assured that the entire December will be a joyous moment for you. But if you have a reference, God forbid, if you have reference in any of these subjects, certainly each time you remember, even if you are eating, no matter how sumptuous is that food that your meal that you are having, once you remember that, oh, there's a reference, you feel bad. Therefore, that's what I'm encouraging you. Please put your best, sacrifice now, so that you can hand the reward when your result is released. You can get the best out of it. It's not difficult. I can bet you. ICANN exam is not difficult. Just so going forward now, what you should be doing is to be solving Pathfinder question and answer. Just be solving, practicing, because confidence is a function of experience. Your experience will come from your practice. You have to practice as many questions as possible, and that is one of the benefits of this ebook. There are so many illustrations that you can test and they check the solution from there so that you can gain that knowledge. At the end of the day, you don't struggle, so that when you see when you see a similar question on the day of your exam, please guys, we're expecting you. We want you to win prizes, not just about pass. Don't make yourself average students. Okay, you have to pass. You have to pass your exam excellently, so that at the end of the day, Equity will be able to take the pride. You own the success. We own this pride, because we want to see you succeed. God will make it easy for you. Thank you guys for your time. We hope to see you next diet, when we shall be taking you at professional level. Good night, everyone.
Good night, sir.
Good night, sir. Thank you so much, sir.
Thank you.
You're welcome. Congress, Kunle,
In case you have
Friday.
question, we can reach out to you
You can
privately.
always, any of the lecturers, you can always reach out to us. We've already communicated to all the tutors that student will be coming to seek for clarification and help. So you can reach out to any one of us.
All
Okay?
right, sir.
All right. Bye-bye.